All right, I hope everybody's doing well today. My bad, I was muted initially. So, thank you guys for tuning in to this week's SimpMe webinar. Now, we're going to switch it up this week. Typically, we talk a little bit about the SimpMe program, the SimpMe flywheel, the wealth building flywheel, but today I want to talk more specifically about the bond market. And the reason why I want to talk about the bond market is because there's been a lot of action in the news lately. More specifically, it's important to understand what the bond markets are doing because that really dictates your life as an American citizen, whether it's how much your mortgage is, how much your car loan is, how much your student loan is, etc. The bond market is what dictates how much people pay for debt, borrowing, financing, etc. It's very important to understand that considering we live in a debt-based system. So today I wanted to talk a little bit about that, what's been going on in the market, etc. So first, to kick things off, we are going to start back with what has happened over the past couple of days. So if you can see my screen now, what you'll see is that the article states that the Treasury Secretary Scott Bessent doubles the U.S. long bond buybacks in the face of surging yields. Now, before we even get into this, let me explain what a bond is. A bond is debt. The US government will sell and monetize debt. What that means is they will essentially pay nations, financial institutions, pension funds a return through interest to incentivize that institution, that sovereign nation, that financial institution to lend money to the United States government. So if you buy a bond, you essentially are lending money to a government or a financial institution that's selling the bond, and the government or that financial institution is going to pay you back in a yield. They're going to pay you interest. They're going to pay you interest for lending them money. Now, the reason why this is relevant is because the entire system that we live in, financial system, is all a debt-based system. The reason why is because the dollars that exist in the system aren't backed by anything. The dollars used to be backed by gold. I talk about this all the time on our weekly webinar when we have one of our slides where we talk about the difference between money and currency. But in a nutshell, the dollar isn't backed by anything. It's backed by a promise. And a promise that the United States government will make due and pay interest to the individuals that are lending money and lending their money in dollars that they earn from wherever their job, whether it's through their economy, through their financial institution. The safest thing historically that people were told that they could do is to own US government debt, and you'll get your interest payment. Now, the reason why this is relevant as it pertains to the situation with the Treasury Secretary is because the bond yield, right, which is essentially what an investor, a bond person that's investing in bonds is demanding that is paid to them, the yields have been going up. That essentially means that individuals are like, hey, for me to like be a bond investor and to buy some bonds, buy these US bonds, you're gonna have to pay me 4%. You're gonna have to pay me 4.3%, whatever it is. And the yield has been going up. They've been demanding more. Now, this gets very interesting because the yield and the bond yields impact you as a consumer, as an individual. So if you were to go out to your local car dealership and you wanted to buy a car, they're going to essentially look at your credit. They're going to look at how many assets you may have, who knows, and they may say, "Hey, we'll give you this car note." And the dealership is always going to want to do a deal that works for them. They want you to finance it, and they have partnerships with banks. And you're going to be financing a car potentially if you're not buying it in cash. And the bond yields in the market dictate how much you're paying as a borrower when you're borrowing money to buy a car or when you're getting a mortgage or when you have a student loan or even like some aspects of credit card debt. All of those different vehicles, those different things that people consume in America, across the world, but especially in America, are dictated by the bond yields. And what's been happening is that the yields have been going up. Now, when the yields go up, that essentially makes everything around you more expensive. It's very inflationary. As we already know, and what you may feel is things are more expensive than they ever been before. Whether you go to the groceries, You got the war going on in Iran that's sending oil prices up. All of these inputs, all of these macroeconomic forces dictate how much you pay for different things when you go to the store, when you're buying a car, maybe you're trying to buy a mortgage, etc. Because of the bond market is going to tell you the truth. It's going to show you what's going on. So what happens typically is a lot of people will see the stock market reach all-time highs, but they don't really understand what that means. The stock market being at all-time highs all the time is a function of more dollars being infused into the system. And as dollars are infused into the system, they rush to assets, they rush to stocks, they rush to real estate, and that inflates the price of all of these assets. There's only there's so many dollars that were printed, especially after COVID, that as a result, the dollars that individuals earn buys less. Your dollars buy less. So if you know that you go to work and you make $20 an hour, your $20 an hour that you make now won't buy you the same amount of goods 5 years from now and then 10 years from now. And most of the time people will say, oh, it's because everything gets expensive. Well, it's because your dollars are getting more debased and devalued because the dollar is printed out of thin air and you need more debt to prop up the system. As a result, the goal is to keep you as a walking collateralized debt obligation while individuals at the top hold all the assets for themselves. That's really what happens. So you have to understand the difference between currency and money. That's why I always harp on this idea of understanding what the bond market is saying. Now, the reason why it's relevant with what happened this week in the news is because the Treasury Secretary Scott Bessent doubles the U.S. long bond buybacks in the face of surging yields. So what happened a few days before is the bond yields kept going up. That borrowing rate that I told y'all about, let's see, it's at about, what is it right now? The 10 year is at about 4.70. The 30 years at 5.25. The 5 years at 4.39, and so on and so on. This means that the cost of borrowing is high. And it's high because of all of these macroeconomic forces that are going on right now. To add insult to injury, the US deficit just crossed $40 trillion dollars. That's huge. 40 trillion. It's literally like reaching a trillion so rapidly, like every 125 days or so, we're adding another like $1 trillion to the deficit is outrageous. And that is very inflationary for you as an individual. That means that the dollars you earn at work are going to buy less because the denominator of dollars that exist in the system is increasing rapidly. And it's never going to stop increasing. Now, what the Treasury Secretary essentially is stating here some days ago is as the yields were going up, they essentially are admitting that they're going to be intervening to try to stop the yields from going up. They intervene in a way by doing what's called a bond buyback. Now, a bond buyback, what that does is, I'll read it to you. The U.S. Treasury Secretary announced on Wednesday support measures for long duration bonds, meaning long dated bonds, stepping in to staunch, at least temporarily, an upward march in yields that have unnerved global investors. He announced today that they are going to double the buyback sizes for long duration debt, especially after a bond sell-off pushed the 30-year Treasury yield to its highest level since 2007, which is literally right before the 2008 financial crisis, amid worries of imminent escalation in the U.S.-Israeli war with Iran and rising concerns over a deteriorating fiscal picture. Higher bond yields push up borrowing costs, like I told y'all, squeezing households, companies, financial markets, and the federal budget alike. Total public debt outstanding topped the $40 trillion mark on Wednesday. Understand that. Understand what they're telling you. They're admitting that there's nothing that stops this debt train. The debt is going to increase. It's going to widen more and more and more and more. The deficit is going to get wider. The only way they can truly intervene, which is still inflationary, is by printing more money to drive down the rates. All of the intervention that the Treasury Secretary Scott Bessent is mentioning, what they did earlier this week, it didn't really stop the yields from still going up. They went down for a bit and now they're going back up again. And now he's saying we're willing to double the amount of buybacks that we do to essentially swap the buyers, to swap the duration of the debt, essentially to try to intervene to make the yields go down. That's what they're saying. But where do you think that money comes from to buy back government debt? Comes from you. It's debasing. It's inflationary. It's devaluing the dollars that you earn when the government is essentially admitting that they're going to buy back debt in order to manipulate the bond markets. The reason why is because nobody wants the bond yields to just keep skyrocketing, but that's a sign that there are cracks in the financial system that are being kind of glossed over in a way. Most people don't understand that any of this stuff is happening, but it's very, very important for you to understand it, for you as a listener of the SimpMe platform, showing up for these webinars, being in tune with what we post. It's very important for you to understand it. The reason being is because you understanding that bonds are the source of truth in a debt-based system and that the dollars that exist in the economy always have to increase in order to prop up the scheme, you can understand, wow, how can I actually help myself? Now, we'll talk about how you can protect yourself in a debt-based system, but that's very important to understand what's going on. This was all over the news, but I think it still gets glossed over as not being, there's so many news things that are in the news cycle, whether it's AI and all this other stuff, but you really have to keep that in mind. Now, it's important to understand over the past week, since the Treasury Secretary announced this, you can look at gold and we're going to look at the price of Bitcoin. Both these asset classes, which I consider Bitcoin and gold to be money, they have increased over the past few days. More specifically, over the past 5 days, gold has risen by 4.54%. So in 5 days, it's up 198 bucks, literally dating back to about last Friday or so. Which is, look at this. You can look from Wednesday when everything started going on in the bond market, like I was mentioning to y'all, boom, gold goes up. Typically, what happens is when there's uncertainty in the market and when bond yields are going up, people are usually buy harder assets like gold. Gold is a safe haven specifically, but gold is money because you can't print it out of thin air like dollars. People will look at the price of gold and say, oh, I should have bought gold. It's a good investment. Well, gold is the money. What happens is the value of the dollar is being devalued and the value of the gold is staying the same. One gold coin is still one gold coin versus the $1 doesn't buy you a dollar worth of goods 2, 3, 4, 5, 6, 7, 8 years from now. Same thing applies with Bitcoin. Over the past 5 days, Bitcoin is up 16.74%. So on Monday, Bitcoin was at about $62,000. Now Bitcoin's up at like $73,357. So literally in a short period of time, more specifically, we'll go back to that Wednesday date when all this stuff started happening in the bond market. You're seeing the price of Bitcoin going up. It's sky shot up from like 64,000 all the way up to 68. It's climbing, 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 climbing. Now, the same thing here. Gold from Wednesday went here, climbed, climbed, dipped a little bit, but still climbing steadily. Now, this is very important to understand because when we go back to this situation here, I'm explaining to you guys and I'm showing you how the bonds are going up. The bond yields, when the bond yields go up, that typically means that there are some cracks in the system. And the only way to stop rising yields is to print more money, to drive down the cost of borrowing. They want to infuse so many dollars into the market that it drives down the rates. That's the only way. The intervention is here. They've already mentioned it. They're doing what is called quantitative easing. Quantitative easing, to give you an actual definition of what quantitative easing is an unconventional monetary policy where a central bank creates electric money to buy long-term securities such as bonds from commercial banks. This injects liquidity into the financial system, lowers long-term interest rates, and encourages lending and investment when standard rates cuts fail. This is what they're going to do. This is what they want to do. This is what they're trying to tee up. The difference is that they're trying to ease into it, but there's no way they can ease into it. The writing is on the wall. So you as an individual, you have the ability to understand that currency and money aren't the same thing. The reason I say that is because any currency, dollars, yen, euros, the Japanese yen, excuse me, they're all printed. They're controlled by central banks. You see this intervention that's happening with the US Treasuries with the dollars right now. When they print money, it is devaluing your time and energy and the dollars that you earn at work. So as a result, you can choose to save in dollars, which are being printed, or you can buy hard assets like gold, Bitcoin. When you buy hard assets, you're protecting your time and energy. You're saving in things that can't be printed. The volatility in the price of Bitcoin is what scares a lot of people, but you want to accumulate more Bitcoin at lower prices. When the price goes up, you win. When the price goes down, you win. You want to accumulate gold if you don't like Bitcoin. Buy an ounce of gold, buy a gold coin, and keep buying gold coins, and then put them in a safe. The difference is that when you leave your dollars in the financial system, they are lent out, they're borrowed, they're lent out, they're created out of thin air, and your time and energy is going to be debased more and more and more. So it's very important for you to understand that aspect of what's happening in the market. And I really wanted to break this down today because I feel like a lot of people don't understand the gravity of how serious the situation is. And honestly, there could be a real bad downturn, maybe some potential crash. Who knows? But the key is that your time and energy is being debased constantly. And the only thing that you can do is prepare and be aware of the situation at hand. The worst thing that you want to do is just follow what CNBC says and Bloomberg when they say, oh, just buy stocks and just chill until you're 65. Like, no, nobody's going to teach you the stuff the way that I'm going to teach it to you. I'm going to break down the math. I'm going to explain it to you in a way that is digestible. I am about freedom literacy, not financial literacy. Freedom literacy makes you sovereign. Financial literacy puts you in a box to make you subservient. And everything that we do here at SimpMe is about championing that. So if you take anything away from what I'm sharing, understand that the treasury market and the bond market in general is a source of truth. The reason being is because we live in a debt-based system. Don't fall victim to just thinking, oh, the stock market is up, so all is well. Always look at what the bond market is doing. I just broke down to you specifically how the bond market is reacting to all this intervention from the government and how it is moving the price of hard assets like Bitcoin and gold. As a result, it would be wise to read up on some of the stuff that I'm saying, throw this transcript, throw this video into AI and make a summary that is digestible for yourself. But you should be accumulating hard assets consistently because that's what protects you when they print as much money as they're going to print. So I hope that video, this breakdown makes sense to you. And if you guys have any questions, let me know. And also, we'll be doing one-on-one calls for anybody that wants to learn more about how the SimpMe team can help you along your journey to financial or freedom literacy, and much more. So thank you guys and talk soon.